Hey, it's Pete. Welcome to Stock Trading Pro. The stock market has had massive volatility recently. So today we have a very special training for you. As a matter of fact, two very special trainings. If you've ever wondered how day traders navigate the chaos successfully and see their account grow every single week, despite the fact that the market seems like it's just random, but they're on top of it every single day. In these two training videos, we actually have one on using the New York Stock Exchange tick indicator and one on the Volatility Index, otherwise known as the VIX. But watch these two, take a lot of notes, and if you have any questions, leave a comment below the video because this is life-changing, especially if you're an active day trader. If you find this stuff valuable, please do me a favor. Make sure you hit that subscribe button so you get updates, and definitely hit that thumbs up button to let me know this is the kind of videos that you like. So enjoy these two videos. They are action-packed, and I'll bet you're going to take a lot of notes. Have a great day. Hey, it's Pete. In this video, I'm going to walk you through an advanced day trading strategy for stock traders. And I think even more importantly, we're going to break a golden rule of trading today, which says never try and pick tops and bottoms. Now, if you do it correctly, the way I'm going to show you in this video, there's a very high percentage trade using a very specific market internal to determine when the market's going down and has a very high likelihood of following through back in the other direction. It's 13 minutes, but it is packed with easy to follow stuff. You'll be able to set your charts up exactly how I show you. If you find some value in this video, definitely leave me a comment, especially if you have any questions. And if this was something that you like, smash that like button, hit the subscribe button, and I hope to see you soon. Enjoy the video. Remember, watch all 13 minutes. There is a lot in here. You want to watch it more than once and take notes. Take care. That's the first trade yesterday. That's the first sign. Then you need to see, which we did spot yesterday, right around 10:30, 10:45, where the market internals changed. And here's what I want to point out to you, because I'm going to bring you into a little bit of a shorter time frame chart to identify something that it's kind of advanced, quite honestly, but I'm going to show it to you anyway. I want to walk through it. If you don't happen to use the tick, and if you happen to see here, it's the New York Stock Exchange tick indicator. Okay. Now, what you'll notice here, and I'll make this a little bit bolder. Let me see if I could bring that in a little bit more. Right there. Right there is the zero line. So what I want to walk you through with the tick indicator, and I want to point this out because this has a lot to do with whether or not you're identifying that short covering rally versus buying, is the tick reading, the New York Stock Exchange tick reading. Now, there's NASDAQ as well. It essentially tells you how many stocks are upticking versus downticking at that moment. So I'll just use some round numbers so it's easy to identify. So let's say that you have 1,200 stocks going up a penny. So that's an uptick, right? So 1,200 going up, 700 going down at that same moment. So 1,200 minus 700 means you have a plus 500 tick reading. So that's just setting the tone for what the tick means. So I'm just going to put this up on the screen so you can keep an eye on that while we're talking, right? So you can see that blue line in the middle. Right here, this blue line in the middle is zero. So that means at that moment, upticking, down, that's the kind of like the break-even number where all of the stocks on the New York Stock Exchange are kind of right at that same level where there's no imbalance. So how do you use this, and how does this help us identify a short covering rally? So what ends up happening is during the day, you're not watching every single tick, but you're looking for clues of the dominant side of the market to either be slowing down or validated. So here's what I walked everybody through in our boot camp yesterday in our live broadcast during the day. What happened was, and I'm going to point this out to you. I'm first going to explain it to you, and then I'm going to point it out to you. If you could imagine yesterday where the market's pushing down in that first hour of the day, heavy selling, in your mind, you have to be saying to yourself, what would I need to see to continue short selling aggressively? Because again, we're getting into short covering rallies. And what would I need to see to say, I am not short selling anymore? I'm going to step off the gas because something changed. Now, again, this is what separates chart reader from trader. Trader starts to ask these questions and then acts on those questions. You take action on those questions when you get feedback. So we were watching during the day yesterday. We're like, okay, short selling. Then all of a sudden I sat up in my seat yesterday and I said, we just saw selling slow down. Well, that's a lot of S's. We saw selling slow down. So now there's a difference here. And this is the big thing I want to get across. Less selling is different than new buying. There's a big difference. And how do we spot that on the tick chart that I just showed you? So what we do is we'd walk over, and this is actually something that we do pretty much every day. Right here between 10 o'clock and 10:30, we started to see big push down. We saw a higher push down. We saw an even higher push down. And this is all between 10:30 and 11:30 in the morning. So the first thing that I said yesterday while this was unfolding, and quite honestly, right here, if you could see this between 10 o'clock and 10:30, while the market was still going down, I want to point that out because this is a really critical thing. This is while the market's still going down. And if you'll notice here, 10 to 10:30, the price of the SPY actually made new lows. Keep that in mind right now. This is right around just before 11 o'clock. And then you have the tick, which at that same moment actually made higher lows between 10:30 and 11 o'clock. So think about what's going on. You can imagine the market's pushing down. You're looking at the price action, but in our community, I'm on audio, and I'm basically saying, okay, now here's what we're going to look at. This is what we're watching for. As soon as that happened, I alerted everybody in the community that the selling slowed down. The language I used, I said, we just saw less selling, which doesn't mean it's new buying yet. It means that the sellers have dried up because the amount of dominant side of the market where there was more stocks down ticking versus up ticking. So down ticking, negative 500, negative 750, negative 1,000, negative 1,200. The SPY makes new lows, but then we go from negative 1,200 to the next reading where the SPY makes new lows and we have negative 700. So that literally meant that even though the SPY was pushing down, less stocks overall were down ticking. So that was the first sign that the selling short dried up. The next sign that we were walking everybody through was, how do we identify when sellers start to step up? How do we identify in real time while it's unfolding? How do we know that not only have the sellers slowed down, if not stopped, how do we know when the buyers are starting to step up? Now, there's two different kinds of buyers. There's buyers getting out of their short sale. So let's go back to the SPY because that's a pretty good example right there. Yesterday, when they're pushing down, you're short selling. In order to get out of a short sale, you have to buy that stock back. So if you're not familiar with short selling, that's okay. It essentially means you borrow stock from your broker dealer and you sell it in hope of buying it lower. So you got to get out of the trade. And you want to make sure you have the correct language. When you short sell a stock, you're not selling it. You're short selling it. And that's a big distinction because if you were on a trading floor, if you're on my trading floor in New York City, and you say, I just sold the SPY, for example, everybody on the trading floor would think that you bought it and sold it later. But if you actually sold it short and said you sold it, you get people spitballing you because you actually called out the wrong side of the trade, the wrong action in the trade. So in this case here, if you sold it short and it goes lower and you're looking to get out, you have to buy it back. The language when you buy it back is short cover. You covered that short sale. Even though you're buying it, it's covering that short sale. And the language in a trading floor, you're calling out so everybody knows that you were short that stock and now they would take a look at it. So the next thing that we're looking for in the community, I said, okay, that's great. Selling started to dry up. Now we're going to look for signs of buying. So we noticed that divergence between the tick readings, the VIX readings, as well as the SPY. So you put all those pieces together and we stopped short selling and we were looking for a bottom. So now that translates into this rally that we had here, which was basically 456 to 460. So almost a $4 rally off the lows, simply by understanding how to build that argument around the market internals and doing it in real time. Now, again, join the community, get the link below. This was all done in real time. Everybody in our community can vouch for it. So now what do you do? Now, what is the next conservative trade? Well, now you need to see, do they hold the bid? And when I say hold the bid, that means, okay, we pushed it off the lows. Here's how you spot a difference between a short covering rally and new buying. Short covering is typically fast. If you could imagine you shorted a stock, it's going down and it stops going down. Now, you are stuck in that trade. Now, you might be profitable, but either way, if it stops going down, you have to make a decision. I need to book a profit or get out or hit the road before this thing starts to rally because it's going down and it stops. And we noticed all of this just using the market internals. And again, this is where trading becomes so exciting because none of this is a guess. This is like, if this happens, then I'm doing this. If this happens, this should happen next. This is where trading becomes exciting. And it doesn't matter if you're day trading and buying stocks or swing trading and buying stocks, because we're going to tie this all back into whether or not today's swing trades make a great idea. This is what you want to write down. Again, this is today's posted pad moment. Short covering rallies first need short sales, right? You need some kind of sustained move to the downside, which if we go over to the daily chart, we'll know that we did have that. We hit all-time highs, and then we got hit pretty hard, right? We got hit pretty hard over a 5-day period. So that's the short sale window that we're talking about, okay? Now, we don't want to have a conversation. Should you have been a short seller? You know, we're not talking about whether or not you should have. We're just talking about that there are aggressive traders in all different time frames who would be short selling that. Quite honestly, on our coaching call last night, we probably spent about a half an hour discussing the different types of order flow to watch, and whether you're swing trading on the higher time frames or day trading on 1-minute charts. Neither one of them is right or wrong, but you can bet your bottom dollar that there are short sellers in that short window looking to capitalize on it. It's going down hard. It's going down hard, and in, out, but short selling. You eventually get to the point where they don't recognize what we spotted yesterday. And let me go back to the shorter time frame in the SPY, who don't recognize this fast rally. So when you see bearish environment, let's just say bearish momentum in this case, and a hard rally off of that, a fast rally off of that, that's generally short sellers exiting the short sale, because the faster that move to the upside while it's still going down, that's shorts, people who bet on it going down, getting out quickly because they recognized that it is no longer going down, and maybe they're booking profit, maybe they're getting scared. It doesn't make a difference. They have much more expedience. They have much more urgency to get out of the short sale because it's no longer doing what they said it needs to do. Now, the second and more conservative entry, believe it or not, would actually have been over here. Because if this is pulling back, and let's zoom on over now, back over to the tick chart, because I want to bring it back to what we were talking about before. How do you recognize the difference between short covering, as in this particular instance, versus fresh buying? So what we spotted now, remember we started out talking about that zero line, which is, you probably want to take a shot of this if you want to take a screenshot, okay? This is the big thing right here, this zero line. So if you could see in the morning where the dominant from the most of the day, we were getting big negative push. This is negative 1,000, negative 1,000, negative 1,000, negative 1,000, barely going above zero. All of a sudden here at 11 o'clock in the morning, we start to see positive tick readings. So new buyers are starting to dip their toes in. So this is what happens. This is where the short covering starts to happen. This is where the shorts exit their positions. But that's not enough to say it's new buying yet. So that short covering fast rally off the lows, we saw the higher tick reading. We finally got above that zero line. So that was shorts exiting the positions. The next thing we need to walk through, as we're, again, this is all in real time. I'm not this is all from yesterday. I'm just walking you through what we talked about yesterday. Okay. The next thing, when the SPY pulled back, and I'm going to go back over to the SPY at that moment. When the SPY pulled back over here and the tick readings start to stay above zero, now we're saying that fresh buyers are coming in, there's less selling, and the next thing we want to see is better tick readings to the upside to validate now a dominant buying more so than the dominant selling. And that's actually what we started to spot over here. And I just want to go back to the ticks and show you exactly what that looks like right here. So now if we take the opposite of this, which was the extreme negative reading, we want to go to the extreme positive reading. So now here's what ends up happening. You see how we're not pushing down to these big negative numbers anymore, and you start to see how we are also continuing to see less selling, and we are seeing more buying. That right there is advanced stuff. That's stuff that you want to learn, because then when you confirm what you're seeing here, and you mix in the ticks, the advanced decline line, and a whole bunch of other stuff, you start to build this equation in your head. Okay, if this happens, and this happens, and this happens, step 1, step 2, step 3, okay, buyers are starting to step up, and now the afternoon trading becomes pretty good. And that's actually what we saw here in the market, where we vaulted and pushed back to the upside. Hey, everybody, what's up? It's Pete. So what I'm going to talk about now is
this is kind of a stock trading for beginners type of thing. Many traders use the VIX, the Volatility Index, as a directional bias to determine if you want to be long or short your stock. So essentially the way it works is that if the VIX is rising, fear comes into the market and you would expect stocks to go lower. And if the VIX is declining, as it was for a long time, for a couple of years actually, it was kind of declining, and if not just going sideways and not really moving in those low areas, the stock market was continuing just to grind higher. What we have going on in the market today, I think, is a really good lesson, a really good basic lesson in, do you trade your stock or do you trade the index? Because the indicator, excuse me. Right now, the VIX in the market is not doing what it's supposed to. So it's actually kind of an interesting thing. So I'm going to go to the charts. We're going to pull up the VIX. We're going to pull up the SPY, see what the problem is, why it's not working perfectly right now, and then exactly how we're going to trade it into the afternoon. So right now it's around 1:30 in the afternoon on March 24th, 2020. So we're going to go straight to the charts. Let me pull them up right now. And so you can see what we have going on here. First, I'm going to get to the SPY. And the SPY, you can see, is just in a slow grinding move up during the day, right? So big gap higher. Let's put that in perspective, right? So in case you watch this video a couple of months from now, big gap higher. We're in the middle of the bearish downtrend from the global pandemic that's going on. So put it into context, the market gapped higher, the SPY gapped higher, and continued to trade higher. So what we're going to do now, what should be happening right now, would be the VIX would be trading lower. But as of right now, you can see the VIX was actually trading higher. So there's a good question posted today. What am I supposed to do? What normally makes sense is not happening right now. So I'm going to come back to the screen for a second before we go back out to the chart. So the most important thing here to always remember is you have a lot of other stuff that you could be putting into the chart itself, or I should say into your trading decision. Focus mostly on your stock, whatever that is, whatever that security is you're trading. Obviously, Stock Trading Pro, we're talking about stocks here. All of the other stuff, the VIX, the tick, any other indicators that you might use, Advanced Decline Index, those are secondary indicators that could potentially tell you what might be happening next. But in the context here, it's mostly to have confirmation in what you're seeing in your stock chart. But in this case, that's not actually happening. There's a disconnect is what we might call it, right? Some of those old Wall Street things that are supposed to happen all the time, we have a disconnect. So the question that comes in is, what are you supposed to do? So the first part of the answer is focus on what your stock is doing. The indicator is a secondary indicator. But what I'm going to talk about now is what I'm looking to have happen this afternoon and how that's going to translate into trades for this afternoon. So I'm going to go back to the chart of the VIX first. So you can see we have this beautiful uptrend here in the VIX, which should be going down, but it's not. So again, pay attention to what is happening, not what you want to see. What we have is we have an uptrend here and we have a new high. So essentially what's going on here is, and this is actually the proper way to draw trend lines. You have a area where the price action broke. In this case, it didn't actually break, but that's the new trend line, right? So if we really wanted to draw this properly, this would actually go here from this low, not going through any other prices, and this is where the trend line broke. So we're essentially in this box now, and what this is called a potential change of trend. So should the VIX break down out of this range, we would expect a much more significant push to the upside in the afternoon and maybe even hold into the close. Should the VIX actually break higher and push through the highs, then I would actually expect stocks to roll over and I'd move up my trailing stop. So you can see how what's going on in the VIX is going to, now that it's sideways, give us a, what's the word I'm looking for? Structure for what we're looking to see happen in the afternoon. So again, it's not doing what it's supposed to, but as traders, we have to know what we're going to do next no matter what happens. It's what's probably going to happen and what we're definitely going to do. So map this out for yourself. It's a 5-minute chart of the VIX. Draw the little trend line in the box like I did now. If the VIX actually should take off and make new highs this late in the day after a big move and the big stuff that's going on in the market, VIX takes off new highs, will probably roll over in the market, and that would be an indicator to, or a sign or signal, whatever you want to use, to move up your trailing stops and lock in any intraday profits that you might have. If the VIX rolls over and breaks this trend line, we can then expect the market to close strong into the close. Maybe you could squeeze some extra profits into the day. So a little bit of a stock trading for beginner lesson there, but a kind of a cool one because it's pretty simple to implement. You're just matching the time frames there. So have a great afternoon, everybody.